Great. Well, welcome to our webinar today. We're very excited to have you. Today, we're going to be talking about how action that Colorado took to protect consumers from online lenders that have a tool to evade Colorado law. I'm very excited to be joined by this esteemed panel and to have a keynote speaker from our Attorney General here in Colorado. As I said before, we're very excited by an action that our state took, second state to take this action to protect Colorado consumers from online lenders that may try to evade Colorado consumer protections. It is not effective yet, so we do need to make sure that that goes into effect on July 1st of 2024. But we're going to talk a little bit today about what is the history of this action that Colorado took, this opt-out that we'll describe a bit more. So what was that action? What's the history behind it? We'll also talk about why it's important, why it was important here in Colorado, and potentially some lessons learned for other states that may be looking into this as well. So I'm very excited to be joined by two of the legislators that moved this bill forward, as well as Jessica Whitney, who's a Deputy Attorney General in Minnesota right now, but was very involved in the implementation of this law in the first state that did this in Iowa, as well as Ellen Harnick, who works with the Center for Responsible Lending. I also want to thank all the different partner organizations that helped promote this webinar and helped us put this together and also advocate for the passage of this, including the Bell Policy Center, the Center for Responsible Lending, Towards Justice, the Community Economic Defense Project, the Denver Foundation, the National Consumer Law Center, and Consumer Federation of America. So very excited to also have our Attorney General here in Colorado, who really over the last 5 years has helped to bring about some very strong consumer protections in a variety of different ways and places. We've seen a lot of progress, and on this particular action, he was right there stepping up and advocating for this and helping to ensure that it got across the finish line. So I'll turn it over to you, Attorney General Phil Weiser. Thank you so much for joining us today.
Thank you, Danny. Thanks for all your leadership at COPIRG. Thank you, Ellen. Center for Responsible Lending is a great partner, and we couldn't ask for better legislative partners than Senator Julie Gonzalez and Representative Mike Weissman. Their steadfast support of consumers and for fighting for those who might be preyed on is something that we should never take for granted. In 2018, when I was running, we had a ballot proposition, Danny. You worked hard on this around predatory lending. And remind me, Danny, I think it passed with like 75% or 78% of the vote or something like that.
Yeah, absolutely. High 70s.
So that says something about the importance of consumer protections, that the people of Colorado are expecting us to protect them from predatory lending. We have to recognize that there are companies out there whose business model is to take advantage of those who might be preyed on because they may think, okay, this is all I can do, and then find themselves digging in a deeper and deeper hole. What we can do is develop innovative and effective protections. And the bill that I know you'll be talking about today is a great example of that. But I want to underscore, it's not the only example. I think Danny said this really well. We've had a series over the last 5 years of protections for borrowers, protections for consumers. And I'd like to emphasize a little bit of that constellation. And we're going to keep working on that very front. How can we do more to protect people who otherwise could be preyed on or vulnerable? I need to give a big shout out, and I know the people on this Zoom were behind as well. We have an Office of Financial Empowerment here at our Department of Law. That office has a mission that is crucial for people who are unbanked, who are not necessarily financially literate, and who are vulnerable. We don't have to accept that as inevitable. We can actually work with people, creating financial empowerment coaching, something we're looking at right now, creating this program Bank On to give people access to bank accounts without burdensome fees. And that's something that is really a team effort. I know everyone who's here, obviously in the panel, but participants here as well, are aware of and committed to that work. And some of the Department of Law team members maybe can put in the chat some of the details. I want to also know that this has been a work that predates me. So 2010, I think Colorado ended this payday loan and made a modest change. Then, of course, the 2018 effort I mentioned put a cap in place, 36%. And that's critical. And we've looked at that and we've looked to defend it. Part of why we did pass this law that Danny talked about is because there were firms finding ways around that 36% cap. And we took enforcement action, that we defended our lenders and defended them from predatory fees or interest rates. We need to continue to defend and to refine our regulatory system so that everyone is protected. One of the things that I would underscore is there's predatory installment lending that's been done. And some of the loans, small dollar loans, have been as much as 199%. This is a real problem. And our investigations have found that some of these loans that were over 100% were 76% of the total loans. And so we took action, but I think the challenge is, this case was called Easy Pay. Why are these companies out there? And the answer is, well, if they say, okay, we're going to be an out-of-state bank and the out-of-state entity doesn't have the limits, then they say we can get a loophole from your Colorado laws. And that, of course, didn't sit well with us. We need to make sure we've got a regulatory system that protects Coloradans and doesn't have those sorts of loopholes. And so that's why we worked to have a new law, because going after individual entities like Easy Pay is a little bit of a whack-a-mole type situation. We have to find them, we have to go after them. We wanted a system that's more protective, and thus the opt-out that Danny referred to, that's something where we get control of our destiny. We want to encourage entities who are thoughtful, who are responsible, and we see innovative financial services as a benefit if they can access credit for people who doesn't have it. We want people to be able to be in the 21st century economy. What we don't want is predatory actors who take advantage of people, who charge these incredibly predatory interest rates, leaving people often in a deep hole that it's hard to get out of. I want to emphasize the spirit of partnership and collaboration here in Colorado. This is something that I don't take for granted. We have really a special community going on with advocates like Danny, with partners like Ellen, and legislators like Representative Weissman and Senator Gonzalez. We want to keep being at the table with you as we work through these issues. As we see things for improvement, we'll raise them. As you have questions, we appreciate you coming to us. The work that we've done, and I want to call out our Assistant Deputy, Martha Fulford, has really been impactful. One of the first things I did was to hire Martha, and the clapping is well-deserved. She has built a team. Carmina Lass has already put in the chat. She's the head of our Office of Financial Empowerment. That was another home run for our team that we've been building. We're steadfast in this work. And if you as a consumer or you as an advocate know about problems out there, let us know about it. You can go to our website, coag.gov, and see what our consumer credit function is. We're one of the few AG's offices, I don't know exactly the number, but we have the double whammy of we oversee lenders, and we have this authority that we can do all sorts of oversight, and we have the authority to enforce the consumer protection laws, and those two go hand in hand. And now in the trifecta, we have a financial empowerment effort for consumers as well. So we think those are three valuable tools. We're working to develop more tools, more ability to support consumers, and this work is critical. So I just want to thank you, Danny, for your leadership. It's great to join you all. Excited for the panel to pick up some of these threads and to continue this important work.
Great. Well, thank you very much for joining us this morning and for those words to kick us off. It really is makes it a lot easier to work in a state where we have an attorney general who really takes consumer protection seriously and is looking for ways to protect consumers across the marketplace. So thank you for that. All right, so let's turn to our panel here and really get into the nuts and bolts of what this bill is. So the bill title is, or the bill number is HB 23-1229. And we have someone here who has a level of expertise on this, because there was a state that took the action that we're going to talk about today before Colorado did this year, and that was a state in Iowa. And so we have Jessica Whitney here, who is the Deputy Attorney General in Minnesota, but spent many years in Iowa, and she can give a little bit of background there. I'll go ahead and share my screen. Well, actually, Jessica, if you want to say anything first, and then I can share my screen with your PowerPoint, or I can go right into the PowerPoint.
Oh, go ahead into the PowerPoint.
Okay.
It's great to be here with all these amazing speakers, the Attorney General, the Senator, the Representative, and as always, Ellen. So thank you for having me. I'm just going to give a little bit, hopefully at a easy to digest level about what this is, because it sounds pretty technical, but I think at its heart, the way to stop this state rent-a-bank is pretty simple. So it's called an opt-out. And big caveat, these are my opinions. I'm not here in my role as the Minnesota Deputy Attorney General. I'm here as having been in Iowa for 18 and a half years and been the administrator of the Iowa Consumer Credit Code and worked in this opt-out. So the DIDMCA opt-out, the DIDA opt-out, you'll hear it called like several different things. It's an opt-out of a 1980 law. And I apologize, I've got a cold. The Depository Institutions and Deregulation and Monetary Control Act of 1980 is our home base. The next slides will talk about the opt-out and what its consequences are. I give credit, my former colleague at the Iowa Division of Banking, Zach Hinks, he and I used to do this together. So part of this presentation is work by Zach. So setting the stage, what happened in the late 70s? I love this. You can kind of see, get you going. I was a baby, but we've got some Kenny Rogers, some Star Wars, Grease. What else do we have? Next slide. We had stagflation. If I were here in person, I'd make you all tell me about the late 70s, but since we can't do it via webinar, I'll just go ahead. We had stagflation, the Iranian Revolution, oil shortages, long gas lines, high inflation. So states that had smaller interest rate limits, you had banks pushing against those because they wanted to be able to lend at higher rates. And in particular, national banks. And we had this court case, Marquette National Bank versus First of Omaha. So Marquette's a bank actually located in Minnesota, or was located in Minnesota. And it's a court case. At its core, what it does is the Supreme Court said the National Bank Act preempts state usury laws. So it doesn't matter what state a national bank is doing business in, they can charge the maximum interest rate of where their home state bank is located. So wherever their home is, they get to export that interest rate all over the country. And this only applied to national banks. State charter banks were subject to state-specific usury laws. And at the time, again, in the late 70s, there were lots of smaller interest rate limits than we see right now. So this made some state banks cry unfair. They wanted to be able to export their interest rates, especially the state banks that did business across state lines. So Congress adopted this Depository Institutions, the DIDMCA, which we've already talked about, of 1980, to promote this parity between national banks and state chartered banks. And it says, hey, now state banks can charter, or state chartered banks can also export their interest rates to other states, so that interest rate of their home state can be exported to another state. But we have a huge exception. States can opt out. So a state can say, no, I don't want to be a part of this exportation of interest rates. Therefore, what happens when we opt out is our state banks cannot export, but conversely, no other state bank can import their interest rates into our state. So our state interest rate limits still apply for all state banks, essentially all lending institutions except national banks. The opt-out is still a possibility. Iowa did it way back in the early 80s, and several other states did at the time as well, in Puerto Rico. There was a mortgage loan specific portion, and that deadline has long sailed. It was April 1, 1983. But the other opt-outs don't have deadlines. So states are still allowed to opt out of DIDMCA. Next slide. And I'll talk about Iowa's approach, but that's what you all have done in Colorado, is you have opted out of DIDMCA. Iowa did this in 1980. We have a Uniform Consumer Credit Code, much like you do in Colorado, and you can see we put it at the very preamble, like it's a hard to find spot. Sometimes people miss it. But essentially it says, any loan made in this state by a state chartered bank, either located in this state or other states, are subject to the interest rates that our legislature chooses to set. Next slide. So what does this mean in today's age? And then I can talk a little bit about what it meant for Iowa. Like I said, I was there for 18 and a half years. For today, what it means is we'll get a little bit in the weeds here for those that have been in this space, but it means true lender arguments, i.e. trying to find out, is that really the company, is that state bank really lending, or is it someone else using the state bank's charter to export those interest rates? Those arguments become irrelevant because it doesn't matter, the state bank can't export their interest rate. In Iowa, it meant all state chartered banks that were subject to Iowa's usury limit. For closed-end transactions, it's 21% APR, and it was open-end transactions, but there was no cap. So even bank partners of fintech firms and marketplace lenders, again, you become subject to this. Again, it's only applicable in Iowa and Puerto Rico. Next slide. So it applies only to loans made in Iowa. There are territorial application provisions in our Iowa Consumer Credit Code, which determines where the loan is made. And essentially what it comes down to is the consumer in Iowa? Were they in Iowa in front of their computer? Did they walk into a shop front? Then it's made in Iowa. There was some FDIC guidance about where the home state was made, but that only applied to states that opted out or that were part of DIDMCA. And it's inapplicable because 12 USC, that's the DIDMCA site, doesn't apply to Iowa because Iowa opted out, and will no longer apply to Colorado because Colorado has opted out. So essentially it makes it really easy on one hand to say, you know, unless you're a national bank, here are our limits in Colorado. They're the limits we've chosen. They're the limits we want to have as a state, and all of our folks are subject to them. Next slide. All right, that's sort of the background on the opt-out. The practical implications of the opt-out in Iowa, it meant we knew what lenders were going to charge. We had no problem with Iowans getting credit. There's a robust credit union system in Iowa. There's a robust state chartered bank. Non-depository institutions lend. They can lend at up to 36% blended rate. Most lenders were able to go ahead and get one of those non-depository institution licenses. There's not a dearth. Iowa's not a credit desert. It's certainly for over 40 years functioned just as well as all of its neighboring states that had not opted out. Credit was widely available to Iowans, and the Iowa legislature was able again to set their credit rates. As we saw these sort of state rent-a-bank relationships come up in the last 5 to 10 years, it made it easy for us as regulators, when I was a regulator, to go after folks that were trying to evade our Iowa interest rate limits and charge sometimes triple-digit interest rates, thinking they could export a state bank's rate, and they could not. It was very easy to point to these provisions and then get relief for the consumers. So I highly commend Colorado for taking this path. I think they're the first state to try this in decades, at least. I don't think another state has opted out in a long time. And I think it will be good for Colorado just as it was for Iowa.
Great. Well, thank you very much for that context and that background. And it was obviously something that in Colorado we looked to for guidance when we were talking about this at the state capitol. And thank you for joining us this morning, even though you're not feeling 100%, but I certainly couldn't tell. So that was great, and appreciate the presentation. So now we'll talk to some of the legislators here in Colorado who move this bill forward. And one thing I like to emphasize in Colorado is that for any bill to move forward, you need what's called a sponsor. So this is a person or two people who put their name behind the bill and are responsible for making that bill get through the legislative process. And it adds a lot of responsibility, and it is definitely something that no legislator takes without thinking through a bit. And so the two legislators we have on today, Representative Mike Weissman and Senator Julie Gonzalez, not only did they decide to take this on, but this isn't their first rodeo when it comes to consumer protection. Both of them have really stepped up on consumer protection issues for many years here and on many different bills. We also had Representative Javier Mabry, who is another sponsor of this bill too, and want to shout out to him for his leadership. And he'll be speaking about this on a different event that we're doing as well. So it's always hard. Who do you start with, the representative or the senator? But I'm going to just say, since the bill started in the House, we'll start with Representative Mike Weissman. And yeah, Representative Weissman, if you just start, maybe tell us a little bit about what motivated you to bring this forward, and kind of why this was important for you to sponsor.
Sure. Thank you, Danny, and thank you, everyone. It's really great to see almost 100 folks attending this webinar. I'll just say up front, my hope is that we see legislation like this moving an opt-out in other states, blue, purple, even red states. And I hope that folks here who are connected to advocacy organizations will encourage that in your legislatures and support those efforts. It definitely, we benefited, we needed support from folks like Danny and Ellen and their organizations and other folks besides. I do also want to state my appreciation for A.G. Weiser and his staff, who were very, very helpful in both sort of doing some research and developing the substance of this legislation and also helping advocate for it. What motivated me to bring this forward, as Danny noted, I've worked on consumer protection issues, for a number of years. We have this relatively recent history in the 2018 ballot measure where Colorado voters said in an overwhelming way, 77% is in excess of the margin of usually any ballot measure, any issue here. But people said very strongly, we don't want payday loans to be abusive. That was years ago. There was discussion that I became aware of from our advocacy community right after that. Hey, we have this potential gap, and it's called the alternative charge loan statute here. That's what it sounds like. Instead of lending under the payday loan statute, you can proceed under this other statute involving kind of flat charges and instead of an interest rate per se. But the problem there is you would end up with effective APRs well over 100%. So I set out to frame a bill involving that. As I talked with folks about advancing the legislation, we picked up a few other concepts along the way. In Colorado, okay, I see audio is fading. I'll try to lean in closer. I'm sorry, everybody. In Colorado, probably as in other states, sponsors are allowed to choose the scope of the title of their legislation. So we can do a very narrow bill. We could have just had a bill on alternative charge loans, but I wanted to do a broader bill, frankly. And a lot of advocates here wanted to do a broader bill. So we attempted to introduce a military APR-like concept to our state law. We ended up putting that aside for this year for tactical reasons. We hope to bring it back next year. And then the last piece that we're here to talk about is really the DIDA opt-out. I'll be honest, I was not familiar with this particular interesting bit of federal law and how it intersects with state legislative prerogatives. When I started, it's why we go out and talk to allies, because we learn things doing that. Once I looked at it, it became blindingly obvious to me that we need to do this as soon as possible. From a federalism standpoint, I'm aware of almost nothing else like it. Usually the feds have explicitly left space for states, or the feds have come in and used federal prerogative and said, this is how it's going to be. This is an interesting case where Congress laid down some parameters and then let states exercise their prerogative to say, no, we don't want these. Intriguingly, Colorado used to be an opt-out state, and then we opted back in the 90s. Politics were different here then. Weird bit of legislative history. You may or may not have that in your state. At any rate, from a drafting standpoint, it's very simple. It's about a paragraph in the bill. Nonetheless, it is foundational here. And it started to draw a lot of heat in the legislative process as we went on. Senator Gonzalez caught more of that over in the second chamber than I did in the House. But why is it important? Again, it's really simple. This was a loophole that we had to fix. Jessica from Minnesota very capably stated, the history back 43 years ago, the goal was parity, with federally chartered banks. We barely had the internet back then. It existed as a technical matter. We didn't use it. We didn't have smartphones. We didn't have apps. We didn't have fintech institutions in the modern sense of that. So this bit of law that was almost a dead letter has become deeply problematic in the modern era, because we have decent laws here that, as you've heard, we're working to improve. But what good do the consumer lending protection laws that we have do if they can be stepped around very easily by this provision of federal law that we had not, as of this past session opted out of? I would further add, just on a more personal note, I live in and I represent a pretty low income community. We know the statistics nationwide. Half of American families couldn't come up with $400 or $500 to deal with an emergency, car repair, medical bills, your fridge dies, whatever. So we know that there is a need for high interest lending, but we need to keep that as fair as possible. We need to keep the predatory practices out of the high interest space. That's what this legislation is about. I would wrap by saying, I think everyone knows this, but it's important to emphasize, because when you get into the conversation about your state exercising the opt-out, there will be some kind of extreme rhetoric about consequences. It's important to separate fact from fiction. We are not saying out-of-state banks cannot lend into Colorado. We are not saying that an out-of-state bank cannot choose to work with a fintech partner if they want to. That's a business choice. We are saying that when you are lending to Colorado borrowers, Colorado's law applies. That is us exercising our prerogative as a dual sovereign under our system of federalism. That is us as state legislators doing everything we can to stand up for our constituents who may need to borrow in duress situations. So thanks.
Great. Well, thank you very much. And we'll have a little conversation here in a second, but let me bring in Senator Julie Gonzalez. One great thing about working with the senator, not only does she bring that legislative perspective, but she comes from that community organizing background, and I think really understands, when you're talking about small adjustments to APRs, it could mean hundreds, if not thousands of dollars more in borrowing costs for consumers. And so, Senator Gonzalez, would love to hear a little bit from you about why this was important and why you took responsibility to get this bill passed.
Absolutely. Thank you so much, Danny. And thank you to everybody who's on the call today. I'll just say that anytime that Representative Weissman, that Danny, that the AG gear up for battle for consumer protections, I am like, sign me up. Honestly, this work is complicated, nuanced, and quite frankly, a lot of our consumers who would be directly impacted by this bill are out living their lives and aren't necessarily reading the fine print of DIDMCA, of federal statute, and who are working 2-3 jobs in order to keep up with housing, cost of living, and everything else. Prior to my time in the legislature, I worked at an immigration law firm and worked as a paralegal, supporting families in that moment of crisis when everything is falling apart. And it was in those moments of crisis where you really want to be able to make sure that folks are protected and not being taken advantage of, And so I would see the ways that people would say, well, let me go get a payday loan, or let me go get this, how am I going to make rent, and those are the types of protections that we want to put forward here in the state of Colorado. Certainly the AG talked about a host of other policies that we've worked on. And what I'm really excited about in terms of Colorado's statutory change in 1229 is that it is a simple policy that brought forward a lot of political pushback, like a surprising amount of pushback, particularly in my chamber. But when I was talking to my legislative colleagues about this, they often would say, well, wait a second, didn't we already pass the ballot initiative? Haven't the people of the state already spoken clearly about this? And reminding folks that actually, yes, and this will help ensure that our Colorado protections cover all of the banks, matters greatly. And so we did hear quite a bit of opposition and pushback. But at the end of the day, recognizing the opportunity that we have to protect Coloradans so that when they're in the moment of crisis, right, whether it is your fridge goes out, whether it's, a car repair, whether it's whatever the thing is, that folks are protected by the statutes that we have established here in Colorado. And so that's why I signed up for this fight. It's why I'm so proud of the win that we're able to accomplish. And if you're not in Colorado, by all means, please engage in this work. The language of 1229 is listed there in the chat. Feel free to reach out to any of us on this call because we think that this is a great opportunity to protect the folks in your communities as well.
Great, thank you. And so for either Representative Weissman or Senator Gonzalez or both, I guess put a finer point on, if you have tips or advice for another state, if they're considering this, was there anything that they should be, prepared for, or anything that really helped you make the case? I guess Representative Weissman, do you want to go first on this one?
Sure. I guess I would sum it up by saying, get ready for a fight. And there are some questions in the Q&A by which we can sort of draw out what that means. What's really interesting is, again, like this issue has been sort of sleepy in the country for, years, possibly decades. We appear to be the first state to have even floated a bill to re-exercise our opt-out prerogative in a long time. The bill moved with sort of average tempo through the committee process. We kind of got stuck on the floor calendar for a while behind some other very sort of big controversial legislation. I actually think had that not happened, we might have been able to move this, frankly, before some of the national fintech entities became aware. At any rate, that may or may not be true. It doesn't matter. What I do think is true is there was at most one mulligan, and I'm sorry to the rest of the country, but Colorado has apparently used that mulligan. We both, all of us here, want to see other states raise this issue for the sake of your borrowers and your constituents. But I think that those who benefit from being able to lend into a non-opt-out state will fight it, and we can flesh out more kind of what that rhetoric is going to sound like. But again, most of the fight was in the Senate chamber, so I'll let Senator Gonzalez comment more on that.
Yeah, Senator Gonzalez, any tips from you on what to be ready for?
I will just honestly say that I was a little caught off guard in that, to me, it seemed rather straightforward. We had a ballot initiative that clarified what our Colorado voters had intended. And so when I started hearing pushback from fintech companies, I'm not going to name folks by name, but I have a card for when my refrigerator went kaput that I used at a local store. And to hear from fintech companies who had relationships with those stores saying, well, we just won't be able to lend at all. The sky is gonna fall. And it was like, wait, when you can still charge, was it 36% APR? You're not going to be able to lend here in this state. It was a little bit of like the sky is falling, Chicken Little, and it was surprising and fierce and loud. And again, when we started having those conversations with my Senate colleagues, it became very clear that and we were able to pass the bill out of on the Senate floor in the sort of waning weeks of the legislative session. But it was loud opposition. I did receive, some of my colleagues received letters that were very much like form letters from people who you could kind of tell they were all written in the same handwriting. It looked like people, as they were signing up for the loan, were also then sending these advocacy letters saying, hey, don't take this loan away from me, those kinds of things. And my colleagues were coming and saying, wait, what is this letter? Aren't folks confused? Didn't we already do this? And then when I'd explained to them the provision that we were trying to enact in order to ensure that out-of-state banks were also respecting our Colorado statutes, they'd be like, that's easy for me. I got this.
Yeah. Well, Ellen, why don't you hop in here? So Ellen Harnick, let me get this right. Executive Vice President, Director of State Policy, Western Regional Director, Center for Responsible Lending. And talk a little bit, give us a little bit of the numbers. So I think one of the things that matters here is Colorado actually has thought about a tiered APR system, a tiered, lending system, which makes a lot of sense. Like a 36% on a, $500 loan is going to be very different than 36% on a $10,000 loan. And so we have a tiered rate system. And so if you could talk a little bit about just that and how this opt out, what are the real world implications of this opt out?
Thank you, Danny. And I'm going to take advantage of the fact that it's going to be hard for you to say no to me right now by saying, can I answer a different question first?
Oh, sure. Of course. Of course.
Okay. So a number of people asked in the chat, and it came up again, who were the opponents? And this matters before I explain the cost of some of these large loans at up to 36%. It's interesting. The biggest opponents were not the companies like EasyPay, which the Attorney General mentioned, who there's almost no, it's so obvious there's no justification. You can't charge people 150% APR for a $1,000 loan or a loan to buy a puppy. So the opposition came in more friendly guise, in companies that say, well, we never lend above 36%. It's just that we want to be able to make a $20,000 loan at 36%. And that's where people need to get to the numbers that Danny's talking about. It is a big deal. There is a good reason why Colorado, like so many states, does not allow $20,000 loans at 36%. So just to give you an example, as Danny asked, of the numbers. So a $20,000 5-year loan, if made under Colorado law, the law that the banks, credit unions, finance companies operating in Colorado and licensed in Colorado, those companies following the law would charge up to 21% on that, on a $20,000 5-year loan, which is a lot. That would mean a monthly payment of $541. I should back up and say, and these are all aimed at people who are struggling. They're struggling with debt. And why are they struggling with debt? Because people are not earning enough money to pay bills. So it's not like there's a big payday coming. So even under Colorado law, that would be $541 a month, total finance charge of over $12,000, and a total repayment of over $32,000. But what the opponents of the bill were insisting upon is the right to increase that to 36%. We shouldn't have to comply with Colorado law. We'll make a lot more loans if we don't have to comply. So that would mean a monthly payment of $722 a month, $722 a month, a total finance charge of over $23,000. That means total finance charge that's more than the loan amount, and a total repayment of over $43,000. So what we're talking about are enormous sums of money made by lenders whose argument is we're making loans to people who are struggling and otherwise couldn't get credit. And I'll say one more thing, just in case people want to hear some of the arguments we faced. What people said then, what our opponents said was, hang on, look at the economy. The federal funds rate is up to 5 1/3%. Like, that is high, right? It had gone down to 0. Well, let's remember that the law that they've been exploiting, this law that Colorado wisely opted out of, occurred at a time when the federal funds rate was high. I almost want to invite you in the chat to guess what the federal funds rate rose to in 1980. But I'm going to just tell you, 22%. And in the lawsuit that Jessica told us about, the fight was not over, we want to make $20,000 loans at 36%. The fight was over, it's not fair that they get to charge 18% for the first 1,000 and 12% thereafter. So these are really out of whack. And those were the arguments that Senator Gonzalez and Representative Weissman had to push back on. And it is hard. It's easy when you're opponents come at you with, 150% APR loans to buy a puppy. But the real failure to allow Colorado and other states to make their laws effective, to make their laws meaningful, it means that it's very hard for anyone in the state to take control of policy and protection within the state.
Great. Well, thank you for laying that out like that, Ellen. And so I think, I mean, one of the things that, again, it kind of comes back to, and a bunch of the questions are in here, is like, is it really as simple as just opting out? And I mean, the answer kind of is yes. Like we saw, Jessica showed what it looked like in Iowa. Colorado, while HB 23-1229 had other pieces to it, the DITA piece was very short. The concept is there. So I mean, I think the implication here is, it is something other states should take a look at. While state laws may be complicated, it is not complicated to say you have to follow our state laws, and does feel like something we should do. Representative Weissman, I see you come off mute. Did you want to say something here?
Yeah, thanks, Ellen, for framing it that way. I thought maybe if we have time, I'd speak to some of the questions, just get a little bit into the guts of it.
Sure.
I think, Danny, what you said is exactly right. I mean, it's a simple concept. The drafting is simple. Okay, the politics might not be simple, but it often isn't. I'll try to sew up some of these questions together, and I think Jessica, Ellen, you may be able to add to some of them that are sort of outside the legislative text. There was a question from Adrian about bankruptcy. We're not touching bankruptcy per se. At the point when somebody has debts that maybe are going to get handled in a bankruptcy case, like that law is what it is. Frankly, we hope that by making the cost of credit a little bit more reasonable with the reforms we're making here, incrementally fewer people will end up in bankruptcy in the first place. Okay, we're sort of talking about hurdles and challenges. I'm just going down the line of questions. Anne has a pair of questions. If a state has not opted out, is there something in the statute that would indicate that? This is tricky because you're sort of looking for a negative. As far as I'm aware, I'll invite Ellen and Jessica to step in here. A state exercising the opt-out, whether we just did in 23 or somebody did back in 1981, you're going to find some statutory text specifically affirming that and exercising the right afforded to states under DITA. In our case, it's in our Consumer Credit Code. It's a specific statutory section. I think Jessica mentioned it may be in something like a statutory head note in Iowa, but there's going to be some kind of text. I believe it requires an act of the General Assembly. It requires bicameralism and presentment. It's not just like, the governor can issue an EO and it goes in a file cabinet somewhere 30 years ago. So you would find it in your statutes. Is to Anne's next question, I'm not aware that there's anything like a federal requirement that that the opt-out get codified somewhere in particular. Our nonpartisan staff drafting office always sort of helps us decide where does it make sense to codify things for the sake of clarity. I will note that if you look closely at the text, you will see some words that are pretty weird in statute. Colorado does not want. That was the language used in the prior opt-out, that we opted back out of the opt-out in the 90s. We did take pains to track the language of our prior opt-out and to track federal law. Do make sure that you're calling out the specific federal sections of DITA, just so that if anybody attacks what you're doing after your legislative enactment is signed, you're just being crystal clear about all of that. I guess last thing that I'll note is we made a choice to try to go at multiple issues in the consumer lending space at once. As I noted, we put one of those to the side. The interesting thing about the three issues we were grappling with, alternative charge loans, the MAPR concept, and opt-out, all three of those had different opponents. This may not be the case in your state, but essentially, we kind of found out through doing this, the people making the alternative charge loans here don't overlap with the people making the higher dollar, more general supervised loans and the ones who wanted to fight us on APR. And then, out-of-state banks and fintech partners are different yet again. So on the one hand, particularly if you have a short session or bills that can be introduced are limited in number, may be tempting to go at multiple issues at once, and you may be able to succeed, but do be mindful that you'll be sort of taking on different opposition and different adversaries in so doing if you are to frame a bill that is just the opt-out, which again can be about a page or a paragraph of legislative text. That's a way to kind of scope your fight in terms of your legislative leaders and your outside allies.
Right, thank you. And I think one Ellen, we'll go to you in a second. One other question that was in there is around, what legal challenges do you expect? I mean, I think this goes back to being able to see Iowa, and not only has Iowa makes me feel like the odds of a legal challenge are pretty low, partly because of how the law is written, but also Iowa gave us the confidence to know we oftentimes hear about unintended consequences, and it's very helpful to see. I mean, literally the 80s. I mean, the action Iowa took is as old as I am. And if they haven't discovered, if the marketplace is still pretty darn robust in Iowa and the enforcement is easier to do, then it's probably a good sign. It is just one state. So Colorado is happy to be the second state to show that there really aren't that many unintended consequences, I think, but that's helpful to have as well. So Ellen, did you want to say something here?
Yeah, I wanted to say, just to make sure everyone knows, I think people do, this is a public webinar. And so many of the companies who showed up in opposition are on this call, and they are very welcome here. And we're stating the facts. And I want to be clear, I think there's an invitation to these, to anyone who is interested in consumer protection to share their data about what they're doing, share their data about their lending, and also to, help support the idea that if you care about consumers, you got to care about state law, and you got to care about enabling, not disempowering state legislatures by finding ways to just completely evade state law.
Thank you.
And if I can say, and I do hope, just respectfully, these are respectfully made arguments about why these evasions are so problematic.
With just a few minutes left here, another technical question is around pushback around the other parts of DIDMCA. And I'm not sure, Jessica, if you can speak to that, or Ellen, did you get any pushback on opting out of any other parts of DIDMCA, since the opt-out is from the entire DIDMCA? Can you clarify that?
No, I mean, I don't know if it's that people weren't sophisticated enough to parse because like I said, there's mortgage loans, there's the consumer part. You can't opt out of the mortgage loans anymore. So that ship has long sailed, but it had never been an issue. And to answer the question, someone was asking how they would know if their state had opted out. I can tell you because it's only Iowa and Puerto Rico remain. States had opted out before. You could probably search your legislative history. If you subscribe to the NCLC books, I think they have a little footnote where they talk about what states opted out. But the last folks standing are Iowa and Puerto Rico, and Colorado will soon be joining us.
That's great. Well, so I guess just with our last few minutes, any sort of closing thoughts or sort of reminders, things to emphasize? I mean, I continue to emphasize, and while it may not seem like a big difference, to an average consumer to think of an APR of 21% versus 36%, as Ellen mentioned earlier, a lot of the Colorado law is around, having a tiered rating system for those larger loans. It does seem crazy to me to think that you'd have a 36% APR on a $20,000 loan. To Ellen's point earlier, it is thousands of more dollars in borrowing costs, and it's very questionable what value you're getting out of those additional costs. So I think that's a very important thing. Colorado has thought through what those laws and protections should be. We should make sure that all lenders are playing by the same rules. So I think that's one reason why we stood up and said this is definitely a priority of ours. But I just want to open it up and see if there's any final closing comments or thoughts for folks. And then I put in the chat, We do have a website that we'll be putting this recording up on, which will have those slides that you saw earlier. So feel free to bookmark that link. And the Bell Policy Center also has a great fact sheet for consumers too, if you want to pull that down as well. But any final comments before we wrap up here from any of our panelists? Just come off mute if you have anything else you'd like to say. Ellen, do you want to just sort of mention, we've said it's pretty easy for other states to do this. Is this something other states should be looking at right now?
Well, I think a lot of states are looking at it. And I should say, people were talking about it back when the AG in Colorado and other AGs were suing these companies, companies that were engaged in online lending using the bank partnership. And often it was said in opposition to the AGs, well, if this kind of lending must be wanted in the state, otherwise the state would have opted out. So this has been in people's radar for a great many number of years. And I think what's happened now is just the scale of the evasions is so great that states are taking it much more seriously. So, and I think that it is actually very simple drafting. I think you can reach out to any of the people on this call. NCLC also has very good information on this. There are things you need to check your own state law about, there's drafting nuances, but the policy is quite simple.
Representative Weissman?
Yeah, thanks, Danny. Briefly, I'll just speak to some of the last questions that have come up here. There were two questions. Are we getting both closed end and open end? And then relatedly, why are there certain exceptions for some, but not all credit cards? So yes, commonly, this is the installment lending, so a fixed amount. Then there's the universe of credit cards that are issued by state chartered, in our case, non-Colorado out-of-state state chartered banks. We chose to exempt, and this was carefully negotiated, with the input from the AG's office here and worked out in the Senate. If there is such a thing as an out-of-state state chartered bank general credit card, which just means a MasterCard or a Visa you can use anywhere, gas station, grocery store, whatever, we are accepting that because we believe that that is not where the problems lie for the most part. General credit cards tend to be from federally chartered banks. Where we believe that there are problems in terms of excessive interest rates are, some people call them branded cards, not to pick on any retailers, but Kohl's or Target or whatever. You have a card that works like a credit card, but it's only that store. There do tend to be state chartered banks from, some of the non-interest rate cap states involved here. So we wanted to make sure that we were applying the opt-out to that, but we did negotiate to a certain kind of exception to the generally applicable rule that we are covering with the opt-out. We are covering open-end credit. And then we did that, eyes open. But other than that, by way of closing, again, I just want to say thank you to everybody for your interest in this subject this morning. Senator Gonzalez and I are here to engage in others from other states who may want to take up this issue. And just thank you, Danny and Ellen, for lending your advocacy, and Jessica for lending your considerable history to our discussion as well.
Great, thank you. And again, thanks to our two legislative sponsors who are on here, as well as Representative Javier Mabry. I mean, it can't be understated how important it is to have a sponsor who is ready to put in the work, because to get any bill through a legislative process is a very challenging effort, and to take that responsibility on and to persevere, especially when you're not expecting, you're feeling like this is a pretty straightforward idea, and suddenly you're seeing some opposition from a set of industry groups. It can be frustrating, and we're very appreciative of the work you all put in, and the Attorney General for speaking up and adding their expertise to this as well. So thank you for that, and all the other advocate groups that we mentioned earlier today. It really does take a village to get any of this to happen. So if you're in other states and like any more thoughts or advice, feel free to follow up with us. As I said, I put a link in the chat of where we'll be putting some of the information from this webinar, as well as a good fact sheet from the Bell Policy Center. So thank you, everybody, for joining us this morning, and we'll be in touch. Thanks.